Hello and welcome to Trading 5 Talents. In today's video, we're going to be talking about an options trading strategy known as the wheel. Before we begin, I just want to say I'm not a financial advisor and this is not financial advice. The content is for educational and entertainment purposes only. Any trades that I may mention are not trade recommendations, but either an example trade or a past trade I've made. So please don't enter into any trades you see here. Now, let's get into the video. The wheel strategy is an options trading strategy that primarily focuses on selling options premium. So that's the real key difference between this strategy and other options strategies. As we know, and if you've experienced options trading at all, most options are going to be expiring worthless, which is an advantage to the wheel strategy. So what we're doing is we're actually selling options instead of buying them. And as most options expire worthless, this is going to increase our chance of profit because we want the options to decrease in value and eventually expire worthless. And so the value of an option, as you know, is called the premium. So if you purchase an option, you're paying that premium, which is usually referred to as a cost, and the amount is debited from your account. And if you're selling an option, the option value is usually called a credit, and it's also a premium, and that gets credited to your account immediately. One of the reasons options lose their value over time is because of something called theta. And so theta decay, in our case, is going to be an advantage for the wheel strategy. And theta is an options Greek that represents the negative effect of time on the value of an option. If you want more information about the Greeks, then I'll leave a link in the description so you can check out a video regarding option Greeks. As the expiration date of an option gets closer and closer, the premiums or the value of the option decreases. So this is the theta decay. It's also referred to as time decay. And so when you sell an option, you're called the writer of the option. So when you sell or write an option, you benefit from theta decay. But if you purchase an option, you are at a disadvantage because theta or time is working against you. Every day, your option gets lower and lower in value. So what a buyer of options would do is they would buy low and then hope that it goes high and then they'd sell it. Buy low, sell high. A seller of options, which is what we would do in the wheel strategy, we just simply reverse that. We sell high first, let theta decay do its work, and then we buy it back low, or we let it expire and it expires completely worthless. So the way that I've been trading the wheel, I've generated a list of rules that I do for my trading strategy, and these are just my rules. Other people who trade the wheel might have a different set of rules, but I think the first rule we can all agree on is that you don't want to trade the wheel unless you really are comfortable with holding the stock for a long time. So you have to trade the wheel on stocks or whatever underlying asset that you don't mind holding for a long time. If you want to sell high and buy back low, in order to sell high, you're going to need some volatility in that stock. Otherwise, the premiums are going to be very low. You're not going to be selling those options for very much unless you have that volatility. I like to look for expirations out to 21 days. I usually don't go further than that. I trade weeklies, and sometimes I'll trade them as soon as 2 days until expiration, and then all the way out to 3 weeks until expiration. The chance of profit that I look for is 70% or greater, and this roughly translates into a delta of 0.3 or less. Delta is another one of those options Greeks that I was mentioning, and if you want to learn more about options Greek, go ahead and check out the video link in the description. The rate of return, especially on the put side of the wheel strategy, I'd like to look for 2% or greater. This is the amount of profit that I'd receive in comparison to the amount of collateral that I need to hold to sell the option. And I exit anywhere from 50 to 90% of my max profit. So as soon as I sell an option, or as soon as anyone sells an option, the credit that they receive, that is your maximum profit. If you sell an option for $50, then that's all you're going to make. You're going to make just that $50. So I would exit maybe around $25 once theta decay eats away at about $25, or it eats away at about $45, and I'll buy that option back for either $25 or I'll buy it back for $5, and then I keep the rest. I also want to take into consideration special events such as earnings and ex-dividend dates. So as you know, earnings can fluctuate the stock price wildly. If they're good earnings, the stock price would go up. If they're bad earnings, the stock price would go down. And so I want to make sure those earnings aren't anywhere near the expiration date that I am choosing, because it could really affect my position. So I'd like to avoid earnings. If it's a dividend paying stock, I want to be careful of what the ex-dividend date is, because it could result in early exercise of that particular option. So here's the setup. This is how it would be run. First of all, I would sell a put, and this is called a cash secured put, or CSP. And you have to have enough capital, enough cash in your account for 100 shares of the strike price of the put that you're selling. So just as an example, let's say you're selling a put with a strike price of $10. You need 10 times 100. You need $1,000 in order to sell this put. Now, once your profit target is reached, again, for me, it's 50 to 90% of the max profit. Once your profit target is reached, you simply repeat this process. If your put expires in the money and it gets assigned, that means you now take your collateral and you purchase those 100 shares at the strike price. So if it was the $10 strike price, you would take your $1,000, purchase 100 shares at $10 a piece. So now you own 100 shares of the underlying asset. In most cases, it's going to be a stock. So now that you have your 100 shares, you're going to be selling calls, and these are referred to as covered calls. In the cash secured put portion of the wheel, you were using your cash or your capital as the collateral in the event that your option expired in the money and you're assigned. On the call side of the wheel, you're going to be using your 100 shares as collateral in case the option expires in the money and that option gets assigned to you. So you sell a call, and if your option is still out of the money, you're going to have Theta Decay working in your favor, and you can exit when the profit target is reached, and you can simply sell another call once that one is closed. And you can repeat this process until you get assigned. And if you get assigned, that means your call expired in the money, and so your shares are called away. That is, you sell your shares at that particular strike price. And so you get all your money back, and you can simply repeat the process and sell a cash secured put. So this is what it would look like represented schematically. So you sell a cash secured put, and you're going to get money for this. You're going to get a credit. You're going to get the premium of the put you sold. If it expires out of the money, you can simply close your trade and repeat the process. So you have this mini wheel here. If your cash secured put expires in the money, you're going to get assigned. Now you have to purchase 100 shares. Now with those 100 shares, you use it as collateral, or use them as collateral, and you're going to sell covered calls. Again, as soon as you sell the covered call, you're going to receive that premium. If you closed your position early, or the call expires out of the money and expires worthless, you can repeat the process and sell more calls using your shares as collateral. So you have this mini wheel. Now, if your covered call expires in the money, the contract gets assigned to you, your shares are called away. So you receive your money back from selling the shares, and you can start the process over again. So you can see why it's referred to as the wheel strategy. There's a larger wheel going from puts to calls. There's also smaller wheels within the wheel where you can repeatedly sell puts, or you can repeatedly sell calls. And each time you sell something, you're going to keep the premium. Whether you're assigned or not assigned, you're keeping the premium. So here is just an overview of my rules for selling cash secured puts. Again, I need to sell a put on a stock that I don't mind holding up to approximately 3 weeks DTE, so days until expiration. Greater than 70% chance of profit, approximately 2% or greater rate of return, and I'm going to exit anywhere from 50 to 90% of my max profit. So these are the advantages that I see by running this strategy. If there's a stock that I don't mind holding, and let's say it's trading for $50 per share, if I sell a cash secured put at a $40 strike price and I get assigned, then I am actually purchasing 100 shares at $40. I was willing to buy it at $50, but now I'm getting it for $40. I own the stock at a cheaper price, and in the meantime, I get a credit. I get paid to wait until that stock price comes down. The disadvantage that I see is that it simply requires a lot of capital. You have to have 100 times the strike price that you're selling. So it does require a lot of money. If you want a little bit more in-depth and also some examples of selling cash secured puts, I'll put a video link in the description so you can see how that is done. Now on the other side of the wheel are the covered calls. And before I get into this, I just want to say that I generally start with the put side of the wheel. I generally start with cash in my account, sell a put until I get assigned, then I sell covered calls. Alternatively, you can also start with the call side. You can simply purchase 100 shares immediately and then start selling covered calls. So it's up to you. I've done both, but I generally start on the put side. So if you start on the call side, or if you are assigned, what you first need to know is what your cost basis is for your shares. And that is, what is the average price that you paid per share? If you simply bought 100 shares at $40 a piece, then your cost basis is $40. But if you bought, let's say, 50 of them at 40 and 50 of them at 50, then your cost basis is going to be $45. Okay, you need to know what your cost basis is. So you want to sell a covered call either at or above your cost basis, because if this call gets assigned to you, you want to at least break even on the shares. You don't want to lose money. So if you want to keep your shares, what I generally do is I look for a longer expiration of that option and or a higher strike price, and that just increases my chance of that option expiring worthless. It doesn't get assigned, therefore I keep my shares. The other thing I can do is I can exit early. If I'm already profitable and the price is, creeping back up and I'm in danger of my shares being called away, I can simply exit early. If I want to get rid of my shares, okay, I want my shares to be called away, then what I'm going to do is look for a shorter expiration and or a lower strike price. I'll also want to hold until expiration in the event that the closing price closes above my strike price. I'm in the money, and then my shares are going to get called away. So here are some advantages that I see for selling covered calls. You're going to collect premium. Just like you did with the puts, you're going to collect premium by selling calls. And you can also possibly profit on capital gains or a dividend. So that capital gains is the difference or the profit that you get by selling your shares at a higher price than what you purchased for. So again, if your cost basis was $40 and you sold a covered call at a $45 strike price and it expires in the money, you now have to sell your shares at $45. But that's great because you bought them at $40 and you sell them at $45. That's $5 per share you're profiting in capital gains. So $5 times 100, that's a $500 capital gains that you just made. If you're also holding these shares and it happens to be a dividend-paying stock, there's also the potential chance of you also receiving that dividend. Whatever that dividend is, times 100 shares, then you keep that as profit as well. So you can collect profit as a premium for selling the call, you can collect profit on capital gains, and you can collect profit potentially with dividends. So there's a lot of advantages of selling covered calls. Disadvantage, and this has happened several times to me, and it's going to happen with you as well if you ever sell the wheel, you may end up holding the stock for quite a long time. This is why that number one rule of the wheel strategy is don't run the wheel unless you're willing to hold the stock for a long time. If you want more information about selling covered calls and some examples, I'll go ahead and leave a link in the description so you can watch a video regarding that. One thing I do want to mention though is if you are assigned a put and now you have to buy 100 shares of a stock, or you simply buy 100 shares of the stock because you want to start the wheel strategy on the call side, there's also the possibility that you don't even have to sell covered calls. If that stock price simply rises quickly before you even have a chance to sell covered calls, you can simply just sell the shares and just collect your capital gains. You don't even have to sell a covered call. So just because you have the shares doesn't mean you have to sell a covered call. It's nice to because you can get the premium, but if you are really bullish, you have a really bullish outlook on the stock and you think it's really going to increase fast, then you might just want to hold those shares and then sell at a higher price. So just a summary, sell cash secured put. You have to have 100 times the strike price in money, in cash. That's the cash secured part of the put. You sell a put, you get a credit If it expires out of the money, you can repeat the process and do it again. If you get assigned, then you own 100 shares and you use those 100 shares as collateral and sell covered calls. You'll get a premium and you'll get a credit for that as well. If your call expires out of the money or you exit early, you simply repeat the process. If your call expires in the money and your shares get called away, that gets assigned to you, you're back at square one, and now you can start selling cash secured puts. So wherever you are on this wheel, there's always a potential of making money. So if you have any questions about this topic or about selling options in general, just leave a comment down below and I'll answer it as quickly as possible. In the meantime, if you want to learn more about the wheel strategy and how I use it for lifestyle trading, click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.